Greetings to all. In this video, we will be dealing with the monetary policy and its instruments. So first of all, we need to understand what is monetary policy. Monetary policy is a set of actions that can be undertaken by a nation's central bank to control the overall money supply and achieve sustainable economic growth. It is the control of the quantity of money available in an economy and the channels by which new money is supplied. By managing the money supply, a central bank aims to influence macroeconomic factors including inflation, the rate of consumption, economic growth, and overall liquidity. The RBI is the main body that controls the monetary policy in India. They control the flow of money into the market through various instruments of monetary policy. This helps the RBI controls the inflation and liquidity in the economy. Let us take a look at the instruments of monetary policy the RBI uses. The first one is open market operations. Open market operations is when the RBI involves itself directly and buys or sells short-term securities in the open market. This is a direct and effective way to increase or decrease the supply of money in the market. It also has a direct effect on the ongoing rate of interest on the market. The second is bank rate. One of the most effective instruments of monetary policy is the bank rate. A bank rate is essentially the rate at which the RBI lends money to commercial banks without any security or collateral. It is also the standard rate at which the RBI will buy or discount bills of exchange and other such commercial instruments. So now, if the RBI were to increase the bank rate, the commercial banks would also have to increase their lending rates. And this will help control the supply of money in the market. And the reverse will obviously increase the supply of money in the market. The third is variable reserve requirement. There are two components to this instrument of monetary policy, namely the cash reserve ratio or CRR and the statutory liquidity ratio or SLR. Let's understand them both. Cash reserve ratio or CRR is a portion of deposit with the commercial banks that it has to deposit to the RBI. So, CRR is the percent of deposits the commercial banks have to keep with the RBI. The RBI will adjust the set percentage to control the supply of money available with the bank, and accordingly, the loans given by the bank will either become cheaper or more expensive. The CRR is a great tool to control inflation. And the statutory liquidity ratio or SLR is the percent of total deposit that the commercial banks have to keep with themselves in form of cash reserves or gold. So increasing the SLR will mean the banks have fewer funds to give as loans, thus controlling the supply of money in the economy. The fourth one is Liquidity Adjustment Facility or LAF. The Liquidity Adjustment Facility is an indirect instrument for monetary control. It controls the flow of money through repo rates and reverse repo rates. The repo rate is actually the rate at which commercial banks and other institutes obtain short-term loans from the central bank. And the reverse repo rate is the rate at which the RBI parks its funds with the commercial banks for short-time periods. And the last one is moral suasion. This is an informal method of monetary control. The RBI is a central bank of the country and thus enjoys a supervisory position in the banking system. If there is a need, it can urge the banks to exercise credit control at times to maintain the balance of funds in the market. This method is actually quite effective since banks tend to follow the policies set by the RBI. So that's all about monetary policy and its instruments, and thank you for watching this video.